So first of all, let's talk about the economy. The growth in the US was high. I mean, 5.5 might not sound high, but we had been struggling for years to get out of more like 2% growth. So 5.5 is very, very high. LPL researchers think that this year the economy is going to grow about 4 to 4.5. Again, still very, very, very high, albeit a slowdown. If you remember when Trump was president in 2019, he lowered corporate tax rates and just kind of a lot of tax rates in general. And the stock market boomed, and he really got super excited about getting to 3% growth because it hadn't been that high in a long time. So talking about 5.5 and 4 or 4.5 are just they don't sound big, but those are really big numbers for the biggest economy in the world. So the question is that even good at this point? So if GDP does, again, remember, we're looking for the Goldilocks zone in the middle. If GDP grows too much, that might actually be bad for the stock market, right? Because you're going to see lower unemployment, higher wages, and higher inflation, which could lead to raising interest rates, which could really put the brakes on the economy. So I actually am hoping that the economy grows maybe a little bit less quickly than that, because I think 4 to 4.5 is near overheating. So I actually kind of hope for more like 3.5 personally. And then I think in other economies, they're doing worse. So you look at global markets, emerging markets here at 6.4%, that is super low. I mean, if the US, the biggest, safest economy in the world, is growing at 5.5, and Vietnam is growing at 6.4, that means no one's investing there, right? And emerging markets actually have gotten killed in the last couple of years because of that. It's not worth the additional risk to go allocate a lot of resources to those places if they're only growing a smidge more than the US. The same thing could be true for this year. If they're at 4.75 and we're at 4.25, you're just not investing that much in emerging markets. Again, we will, because of the way that we rebalance, we'll always have some allocation there, but it's not a large one, and it's been shrinking for the last year and a half. So developed even as well, like, why would you invest in Europe or in Australia or in Japan if you're going to get less than the US potentially? So I think between, COVID risk there, that the US market is going to look better than theirs. Although I don't know if that's going to be true for the next couple of years, because those countries haven't really spent their way out of the 2008 crisis and this crisis like the US has. For example, Germany has about 60% of their economy is debt. Their debt to GDP ratio is about 60%. The US is now 122%. So we have double the debt per GDP. And because our country is much larger, we've got way more than double the actual real debt. So if those countries still have some what I would call dry powder to spend, meaning if they saw a slowdown and they didn't have inflation and they wanted to stimulate their economies more, they've got a lot of room to do it where we don't have as much room. So although in the next year or so, I think we are probably going to beat the other large economies, if they decide to stimulate, they could potentially pull ahead of us. And more long-term, I hope by what we're doing, we're growing our economy to therefore shrink the debt per GDP. But also, if Germany has 60% debt to GDP and we have, let's say, 150 in a couple of years, that debt could also potentially be a problem. I know a lot of people view that as a problem today. I personally don't, but it could certainly be a problem, maybe 8 to 10 years from now. So inflation, let's talk about a little bit about inflation. Inflation is a huge problem, not because inflation is a problem. Inflation is just stuff costs a little bit more. That is a problem not for most of our clients, but unfortunately for a lot of the people at the lower, mid, and lower ends of the economic spectrum. Their incomes are going up, but inflation is going up and just eating right into those gains. So that puts them in they're not increasing their position, but they're also not decreasing it, because wages are up about 11% in the lowest quintile of income earners, but inflation is up a lot as well. So they're making small gains, but not as much. Where inflation is a problem is, how do you stop inflation? For anyone who was an adult in 1980, they know that answer, right? What Reagan did with Paul Volcker when they got together and basically said, we've had inflation since World War II. We have to stop this. You spike interest rates, you cause a recession on purpose, and then you get back to normal. We don't want that to happen, of course, right? We don't want the government to have to step in and stop inflation by jacking interest rates through the roof, which then puts the brakes on the economy and causes a fairly substantial recession. The recession in 1980 was the shortest one of all time before COVID. So it wasn't this like multi-year catastrophe, but it's still a recession I think everyone wants to avoid, which I think that potentially we can. So, we think inflation is going to be a little bit lower this year, but all of the economists are saying it's going to be high the first, 3 to 6 months, and then low the second half of the year to get to an average of 3.7. I'm worried that average is a little low because right now inflation is more like 6%. Again, that's the highest you've seen in a while. Now that is 6% based on what we feel as consumers. So this gets a little in the weeds, but I think it's super interesting. So I'm going to take a minute to kind of explain it. The blue, this is inflation since basically the year I was born, right? 1978. So the blue is inflation. You can see inflation was high. 1980, Reagan and Volcker got together. They raised interest rates like crazy. They got inflation low, and it's never been high since, right? It's 40 years. So we know how to fix inflation. The problem is that means a recession. And then it's been low ever since, and kind of out, so way up and then down. And then out here now, you see CPI is really high. And everyone quotes CPI, kind of like how people used to quote the Dow Jones stock index. The Dow Jones has 30 companies and they're all in industrial. There's not a lot of tech or things like that in there. No, no healthcare, no any, biotechnology, artificial intelligence. They're just older industrial companies. But people are saying, well, what's the Dow doing? It's 30, it's not representative of the economy at all. That is how the Fed feels about CPI. How the Fed feels about CPI is that CPI is what human beings, you and I, respond to surveys and say, here's what I feel like I'm spending more money on. The Fed, the Federal Reserve, tends to look at this orange line, which is trimmed mean personal consumption expansion. Whoa. What does that mean? That just means all they're doing, instead of asking people, how do you feel about what you're paying? Do you think you're paying more? They ask companies, what are you actually charging people? And the government watches that. They don't watch CPI. And then trimmed, how you get the trimmed in there means they take out a couple of things. Like they trim down energy because energy fluctuates a lot. They think long-term that'll kind of even out. Food, goes up and down a lot, and they think that'll even out. So they kind of trim those a little bit. And when I say trim, the PC is actually a pretty good thing to look at because it is representative of what the people's actual budgets are. So for example, if housing goes way up, right? Let's say interest rates go through the roof, plus prices are still rising, a big chunk of people's income is now going to housing, where if like birthday cards go up, it's not really that big of a deal, right? It doesn't impact us that much. So PCE takes that into account. So if, it is proportionate to what most people's spending actually looks like. So it's a good measure. I don't know that it's as accurate as, just like everything in the world, because it could be, but that's what the Fed looks at. So again, why I mentioned this and why I think that this is like kind of in the weeds a little, but is important, is if the Federal Reserve is looking at this orange line, they're not looking at this blue line. And they're saying inflation is right in line with what we're comfortable at because we want 2 to 2.5, 3%. So a little bit of inflation is good. If you remember the last 15 years, we've been worried about deflation, right? The opposite. And we've been working hard to stimulate the economy to not have that. Japan has had deflation since, in 1989, and it kills an economy. So inflation is good, but too much inflation spikes interest rates and kills you. So again, this is the Goldilocks zone of, if we can end up with 3% inflation for the next 5 years, that's perfect, right? If we end up with 6% inflation and the government has to spike interest rates and the 10-year treasury also spikes, that I think will put the brakes on the economy relatively quickly.